So today we're going to be solving a question on piecemeal realization. So let's read the question first. Ada, Udo, and Ngozi are partners in a partnership, sharing profits or losses in the ratio 3:1, respectively. The partnership statement of financial position as at 31st of July is shown below. Moving on 1st of August 2018, the partners decided to dissolve the partnership and assets were realized piecemeal as follows. So, like in the case of an absorption, the realization just took place once. But here we have a piecemeal realization, meaning on the 3rd of August 2018, they had a first realization, 14th of August is second realization, and on 31st of August, they had the final realization. So we have 3 realizations. And then the realization expenses provided for was 5,600, while the actual expenses incurred after all realizations amounted to 7,200. The partners agreed that any available cash after settling all liabilities and expenses should be distributed immediately. Show the statement of actual distribution. So like I said, the main goal is to prepare the statement of actual cash distribution, right? And we're going to be using the surplus capital method for this one. Now, so to start with, so before we do anything, we have to first compute our distribution sequence schedule. We're doing this based on the surplus capital method. So we have to compute our distribution sequence schedule. And the whole purpose of this, like I've been emphasizing since, the main goal is to prepare a statement of actual distribution to distribute the money realized, right? So we have the profit sharing ratio, which is 3, 2, and 1. And also we have the capital account balances. Where did they get the capital account balances? I suppose that should be from the previous financial statement or the financial statement they give us in the question, which was this. So look at the capital account balances in the question, which is 200, 150, and 100. That's how they got those figures there. And then we have the capital as per profit sharing ratio. So you simply do this divided by this, meaning your capital account balance divided by profit sharing ratio. You get these figures, these 3 figures. Then the next one is you select the lowest 3 and multiply by the PSR. So among these 3, the lowest is 66.67. So you simply multiply 66.67 by your profit sharing ratio, and then that will be 200. That will be 66.67 multiplied by 3, and then you keep on doing it for all of them like that. So 66.67 multiplied by 2, 100 multiplied by 60.67 multiplied by 1. So you're using your lowest. You select the lowest in 3. So the lowest here was 66.67, and then you multiply it by their profit sharing ratios and you get this figure. So how do you get the surplus capital now? Now you're simply going to do 2 minus 4. So meaning the previous capital balance minus this new capital here based on the PSL, you're going to get the surplus capital. So these are 150 minus 133.34 will give you this. 100 minus 66.67 will give you 33.3. If you do 200 minus 200, you get 0. So for the profit sharing ratio of 3, we have 0 surplus capital. Moving on, the surplus capital per PSR. You do the same process all over again, and then you have these figures here. How did you get this? 16.66 divided by 2 will give you this. This divided by 1 will give you this. Right? Now the process all over again. I mean, you continue the process. You select the lowest in 6 here, which is what? 8.33, and then you multiply it by the PSR. So you do this multiply by what? This, and then 33.33 multiplied by 8.33 multiplied by 1, because what we expected to do here is pick the lowest in the surplus among the surplus capital, and then you multiply it by their profit sharing ratio, and that's how they got 16.66 and 8.33, and then you get the surplus capital. So at the end we have what? 25,000. And then they said the total cash should be received by Udo and Ngozi before any payment to Ada is this. So for Ngozi, what was the surplus capital that she had? It was what? 25,000. So that's why she will receive 25,000, right? So the next one was what? 2499. It was the addition of these two. So how do you do it? For Ngozi, she's going to receive 8.33, right? And then Udo is going to receive 16.66. And then when you do the addition of that, you get your figures. So the main deal now, the statement of actual cash distribution. So like let's check the previous financial position. So like I said, the main deal is preparing the statement of actual cash distribution. Like that's the end goal. So it's more like a cash account, you get. So what was the cash that was in the partnership before realization took place? It was what? 24,500, and that's what they recorded here as the total, right? And then in the question they had what? I'm coming. In the question they had a first realization which was what? 134,500. That is why it was recorded here. So it was received in cash. It's like an addition, you're not deducting it. They realized money, so as at this date it was recorded here as the first realization. And they said that in surplus capital, once you have paid your once you realize and then you pay your liabilities, then you cannot distribute. You cannot distribute until you have paid your external debts. That's the principle of surplus capital. Do you get? And so this was the cash that he had in the business before the realization took place, and then they received another cash for their first realization, and the total gives us 159. Now, like I said, you must always deduct your liabilities first, and so the liabilities was deducted. I'm coming. You had the liabilities of, yeah, the bank overdraft was 100, and the bank overdraft was 38 and the creditors was 62. If you sum them up, it's going to give you 100, and then they less the total current liabilities. Also, we have provision for expenses. So the realization expenses provided for was 56, while the actual expenses incurred was 72. So it means that the liability they had was their total current liabilities, and then the provision that they made for realization expenses, which gives us this. So when you have less everything from this 159, which was the total amount of cash that they had, like the total amount of cash they received, when you less all these liabilities, you have what? 53.4. Then you can now share, right? And so the first sharing is going to be based on that distribution sequence schedule we did. So you're going to carry these figures here, right? And then you have the first distribution, because in that sequence schedule I said that the surplus capital of Ngozi was what? 25,000. So the first distribution now, we're not doing it based on profit sharing ratio. We're going to first do it based on that distribution sequence schedule. And then the surplus capital of Ngozi was what? 25,000. You record it here. And then the next distribution for Ngozi was 8.3 and for Udo was 16.66. When you total it, you have 33.3. So now the addition of these two will give you this. When you add this up and you minus it from 53.4, you have 3.41 left. Remember that we're also supposed to share this 3.41. We're meant to share this whole amount, but based on that distribution sequence schedule, we're only able to share up to this amount, 25,000 and 24,990, right? So this was what we're able to share. Based what is actually restricting us from sharing this whole amount at once is what the distribution sequence schedule will carry. So based on what we got from our distribution sequence schedule, this was how we first shared it. And then what we have left after doing that, we have 3.41. So since we are done with our sharing it based on the distribution sequence schedule, we can now share this 3.41 based on the profit sharing ratio of the partnership. So let's move on. They said this 3.41 we're going to share it now based on the profit sharing ratio, which is 3:2:1, right? And then it is shared between the partners. Now this also here, we have 1.71 here, we have 17.8, the addition of 1.14 plus the previous distribution. Same thing here, 0.56 plus the previous distribution. Yeah. Now moving on, we are done with the first realization. To the second realization, what did the question say? They received another realization on 14th of August 2018, which was what, 75,000. So it's a what? It's a receipt, like it's an income, a cash income. So 75,000. That's why it was recorded here in the totals. It wasn't put in bracket because it's a revenue, like what they got from the realization. And then we're not using the distribution sequence schedule anymore because we have used it in the first distribution, so it's no longer relevant, right? So now we're going to be doing the subsequent distribution based on the profit sharing ratio. Now this 75,000 is going to be distributed based on the profit sharing ratio. Now when you do that, you get these figures. And then moving on to the final realization, we have what they said in 31st August 2018. The final realization was what? 291.4, right? So that was the total amount that they received at the final realization. And then now it says less on the provision of realization, so 7.2 minus 5.6. So remember that they made a provision of 5,600, and then what they actually spent, they said, while the actual expenses incurred after all realizations amounted to 7.2. So they provided for 5.6, but what? They incurred 7.2, which means they underprovided, and that's like an extra liability. And I said that before you can distribute, you have to deduct your liabilities. You have to remove all external liabilities before you're allowed to distribute, right? That's the rule of surplus capital. And so when you do the difference, you get 1.6. I mean, yeah, you get 1.6, and that's when you less that from your final realization, you get the amount they expected to distribute. Now, why are we putting this under provision in the final realization? Why are we not putting it in the second? Why are we not putting it in the first? The reason why is because they stated clearly that after all realizations amount, after they said realization expenses provided for was this, while the actual expenses incurred after all realizations amounted to this. So it means that after you have made realizations, right? So therefore it means that we're made to account for that in the final realization. Meaning after all the realizations they've done, right? They notice that okay, the actual expenses for their actual realization expenses was 7,200. Meanwhile, they provided for 5.6. So they have to account for that on the provision, which is what, 1.6 here. And when you deduct this, like based on the rule of surplus capital, that you have to remove all your liabilities, and then you get this amount. So now we can now share this final distribution based on the profit sharing ratio. We're not using the distribution sequence. The distribution sequence schedule was purposely for the first distribution, right? And so it's only up to the point that the distribution sequence schedule can carry. That's where we stop, right? And so if you notice that this 3.41 here, the distribution sequence schedule could not meet up with this, so we just use the profit sharing ratio to share it straight up. And yeah, we have the final distribution here is what, 289.8, and then we're going to use the profit sharing ratio to divide to get their share. When you sum everything up, your total cash distribution is going to be equal to all of this. And then the capital contribution in the question, this was their total cash contribution. If you add everything together, you get 450. So it means like this was what they contributed to the business, right? And this was the total amount of money that each of them actually received. So it's like a loss on realization, because the reason why it's a loss on realization is because what they contributed is more than what they actually received after their realization. So at the end of the day, they didn't really make any profit from the business. That's what it directly means, because their capital amount was much more bigger than their cash contribution. So that's how they got a loss. We do this minus this, you get your figures here, and that's how they got a loss on realization, because their capital contribution was larger than their total cash contribution. So like this is basically all you need to know on piecemeal realization. Thank you very much.